Welcome back. Let's take a detailed look at markets in the pre-market in the U.S. and around the world as well. There again is a positive picture in the U.S. Futures market as first quarter earnings season has ramped up in a big way. We're through the banks. We've had some of the big tech players report results, and now we're getting into the broader mix of S&P 500 companies. And we took you through many of those companies, some of the high-profile releases already this morning. Here's how major Asian markets concluded the trading day. Tokyo, as you can see, rose by about 1/3 of a percentage point. Hong Kong rallied again, up by nearly 2%, and the CSI 300, the Shanghai Composite, down by 0.7 of a percentage point. Here's a look at European markets. The FTSE 100 yesterday joined its counterparts in Paris and Frankfurt by trading into all-time high territory. The Paris and Frankfurt indexes reached that level some time ago. The FTSE 100 achieved that level yesterday. And as you can see, it's trading higher yet again this morning. Let's go to the S&P TSX Composite and see where it finished the day yesterday. Up by 1/3 of a percentage point. The notable moves yesterday on the TSX were down. Some of the big gold producers lost significant ground as the price of gold itself retreated for a reason that everybody welcomes, and that is eased tensions between Iran and Israel, or at least the perception of easing tensions. That took gold down, traders said, and companies that are levered to the price of gold fell substantially. Barrick Gold, Agnico Eagle Mines, and Kinross Gold, three of the top losers yesterday in the gold sector. Here, meanwhile, is a look at the biggest winners and losers on a pure percentage basis. Celestica has been bouncing around lately. It is a manufacturer of electronics for original equipment manufacturers, up by 5% and change yesterday. It declined significantly during a day of volatility quite recently. Kelt Exploration in the oil and gas sector, up by nearly 5%. Nova Gold Resources, we talked about the gold stocks. There was a big loser, down by 10%. And Energy Fuels is a uranium stock, down by more than 10%. Here's a look at metals. Gold is trading down. Now, that is still historically a very high gold price, of course, down today by more than a percentage point to 2,319 US dollars per ounce. Silver is also retreating from very high levels. 27.27 is the current price there. And copper down as well from very high levels. 4.43, the current price of copper in the futures market. That's a per pound price. Here's a look at West Texas Intermediate crude, which has been losing ground lately. So the oil and gas stocks will bear watching today. 81.11 is the current price, down very nearly a full percentage point. Here's Western Canadian Select, the Canadian grade of heavy oil, down about 0.5 percentage point at the last pricing to 68.88. Here are some stocks that are moving in the pre-market. Spotify, the music streaming giant, higher after it swung to a profit in the first quarter. The company boosted subscribers and added new features. Paid subscribers rose 14% year over year to a total of 239 million across the world. That's in line with analyst forecasts, according to Bloomberg. Here's a lesser-known biotech stocks. Abeona Therapeutic shares plunging by, as you can see, nearly 47% after the company's drug for a rare connective tissue disorder failed to win approval from the U.S. FDA, the drug regulator in the U.S. Cadence Design is also down after that company's forecast for revenue and adjusted earnings per share in the second quarter fell short of analyst expectations. That one's down by about 7%. Additionally, the software company reported first quarter product and maintenance revenue that missed expectations. We'll also be watching shares of Apple. Investors around the world have been watching the stock for a while now. Look how far it's come off its peak. It was once a so-called Magnificent Seven stock. Now most portfolio managers and market watchers exclude Apple from that category when they talk about leadership in the big tech sector. And one of the big stories on iPhones for some time now has been weak sales numbers in China. iPhone sales in China fell 19% during the first quarter. It could be its worst quarter since 2020. Let's bring in our featured guest, Colin Stewart at JC Clark, for more on Apple. It really has lost its momentum in China, and Huawei, one of its key competitors, is gaining significant ground in that key market.
Yeah, I mean, it just, I think, highlights that Apple is still a company really dependent on one key product, and that is the iPhone. A great product, but, as we all know, when you have an iPhone, trying to upgrade the next one and the next one, the improvements are smaller each time, I think, and that sort of slows the pace of upgrades. And then, as you mentioned, I mean, China being a very key market for Apple, and seeing, I think first quarter sales in China down 19%. The data suggests, and partly because of, I think Huawei gaining ground, and also this, ban by the Chinese government on iPhones for state-backed enterprises, this sort of rise in protectionism, and obviously that's, potentially hurting Apple. And, I would also highlight that Apple, for a hardware company, I think a great innovative business, but still trades at a reasonably high multiple. You go back a decade ago, Apple traded like a hardware company at 12 or 13 times earnings. That earnings multiple is now well up into the high 20s, based on their current expectations.
A lot of people have this stock, obviously, in their portfolios as part of their tech exposure. Any thoughts on this? Do you hold it for your clients?
We don't, and we have in the past. We don't right now. And again, as I said, I mean, we just think there are better opportunities. We do own some Google or Alphabet, for example. We think, it trades at a lower multiple. I think has a higher growth rate, a stronger moat around the business. And Apple, as we know, as I said, is a hardware business, and so hardware businesses should typically trade at lower multiples. I mean, Apple has made obviously inroads into the software side, and a lot of service revenue now, and people are I think willing to put a higher multiple on that. But at the end of the day, that is still a smaller portion of their overall revenue relative to that huge chunk from the iPhone. And I think this recent data highlights Apple still being a company that is quite dependent on China, and when we see weakness there and protectionism, that's an issue for Apple.
And you would not be a buyer at these levels, is that correct?
Not at these levels. I mean, I think at some point, if the stock gets a bit cheaper, trades at a maybe a multiple closer to the 20 or the low 20s, I think that might get interesting, but we're not there yet, so we'll have to see what they say when they report earnings.